Ever wondered what terms like the share market, Sensex, IPO, and stock exchange really mean? You might have heard news like Sensex has risen by 100 points or Nifty has dropped today. But what does that actually signify? In this video, we will break everything down in a simple way. So even if you are new to this concept, by the end you will be confident enough to explore the stock market and even start investing on your own. Let's start with a simple example. Imagine you start a small tea stall in a busy street in Chennai. Your tea recipe is unique and people love it. Every day you sell all your tea and make a good profit. One day you think, if so many people love my tea, why not expand? You decide to open a bigger tea shop with more varieties like masala tea, ginger tea, and snacks. But to do this, you need more money. There are several ways you can raise this fund you need. First, bank loan. You can approach a bank, but there's no guarantee that a loan will be approved. Even if you get it, you will have to pay an interest rate 12 to 13%, and the EMI will start immediately whether your business profit or not. Second one is angel investors. Instead of taking loan, you can bring in angel investors. These investors don't lend you money, they invest in your business in exchange for share in it. For example, you could give 10% ownership in return for 1 crore. The investors won't run your business but will take 10% of the profits. Third one is venture capitalist. As your business grows, you might need even more money than angel investors can provide. That's where venture capitalists come in. The VCs invest large sums of money in promising businesses in exchange for shares, and they help businesses scale rapidly. Now, your businesses is booming and you want to expand maybe across India or even internationally. But this level of expansion requires more money than venture capitalists can provide. So you decide to go public. This means you will raise money from regular people in exchange for shares. This process is called IPO, that is initial public offering. When a company goes public, it is listed on the stock exchange and anyone can buy its shares. For example, when Paytm launched its IPO, its share price was set at 2,150 and it raised 18,300 crores from the public. But launching an IPO is not as simple as announcing it with a loudspeaker. There is a process involved. First, the company hires investment bankers to evaluate its finances, determine how many shares to offer, and set a price. The second one is SEBI. That means Securities and Exchange Board of India must approve the IPO. Once approved, the shares are listed on the stock exchange and people can buy them. After the IPO, the company uses the funds to grow its business. Meanwhile, its shares price fluctuate based on demand, supply, and market conditions. These fluctuations don't directly affect the company, but they do impact its reputation and ability to raise funds in the future. Its company needs more funds later, it can launch another round of public fundraising called FPO. That means follow on public offering. Unlike the IPO and FPO, price depends on the company's current market value. Now you are probably hear news like Sensex rose by 100 points or Nifty dropped by 50 points. But what do these terms mean? Think of television rating. They measure which shows are popular. Similarly, Sensex and Nifty tracks the stock market's overall performance. Sensex tracks the top 30 companies in Bombay Stock Exchange and Nifty tracks the top 50 companies in the National Stock Exchange. When these top companies do well, the Sensex and Nifty go up, indicating a strong market. If they falls, it signals market decline. However, this does not mean every stock follows the same trend. Your specific stock might rise or fall independently. Stock prices fluctuate due to three main groups. First, retail investors, individual like you and me who buy and sell shares. The second one is institutional investors. That means large entities like mutual funds and index funds that invest in a bulk. The third one is advisory and rating agencies, experts who predict market trends and influence investor sentiments. And before investing, always rely on thorough research and trusted sources, not random stock tips from so-called market gurus. To trade in the stock market, you need three essential accounts. The first one is savings account. That means where your money is stored. The second one is demat account, where your shares are stored. Think of it as a digital locker for stocks. Third one is a trading account, the platform through which you buy and sell shares. Think of it like this: you take money from your wallet, that means savings account. Buy a cloth, that means stocks. and keep it in a bag. That means demat account. Opening these accounts is easy. Just install a stock trading app, complete your KYC and link your bank account. And if you ever need help, customer support is available. Investing in the stock market is a long-term game. Avoid falling for scams or misleading stock tips. Do your research, trust reliable sources and invest wisely. With the right knowledge, you can confidently navigate the share market and grow your wealth. Good luck with your investments.